we have with us Mr. Harshvardhan Roongta, and of course he's also going to be answering your questions and queries. So hi Harsh, thanks so much for joining us right here, the ET Now studios. Harsh, let's talk about the whole concept that a lot of mutual fund investors have, that arey market itna gir gaya hai, 11,300 chala gaya. Especially those who are busy in their day-to-day lives, have money parked in mutual funds, which is a great habit to have, but they do not track markets on a daily basis. Firstly, is that all right for a mutual fund investor? Because if they would look at the markets today or for the last 2 days, they would definitely be a little scared.
Absolutely. So Mubina, in fact, we've been advocating to investors saying that investing in equities, now we're talking about equities, not debt.
Yeah.
So investing in equities requires patience, requires you to be invested for long term. So the essentials of investing in equity is that you do not track it on daily basis.
Right.
So if you're right, if your investor was to see what the condition of the market is today or in the last couple of days, he's going to get scared, he's going to panic, and he might not want to invest further or even redeem out of whatever he's got right now. So essentially the idea is that if you are an investor in equities, you are, and via mutual funds, you have a basket of stocks that you're holding. The fund manager's duty is to continuously track the market, which he or she is doing. The idea is you are not supposed to get into that mode and just sit and relax and have faith and invest in a systematic manner, invest with the conviction that you originally had.
Well, yeah, I mean, the whole point of having a fund manager is so that he will take the stress for you of really handling, the funds and what stocks look good, what not. In fact, you just saw on your screens, folk, the Nifty and the mid-cap index, both of them have seen a massive crack, especially in the last couple of days. What a fall scene over there, which brings me now to especially mid and small cap funds. In fact, pull up some interesting data that we saw for even large cap funds. This is a data which shows the cash holding. There you have it, cash holding of mutual funds and how it has increased over the last, I think, a couple of months. So we do have large caps which consistently hold lesser and lesser cash. So as you can see, 5, 4.5, 4.1 and then just 3. But mid caps have held steady at 5.9. Small caps have only now started decreasing cash holding. For all our mutual fund investors out there, would this data worry you in any way, or would you be okay with what you are seeing right now on the screen? Because from what I know is that if a mutual fund manager is holding more cash, it would mean that he himself is not very confident on the market.
So yeah, there are two parts to this actually. So if I'm an equity investor, one set of investors will definitely think that I'm investing money and my objective is to be invested in equities. So why are you holding this amount of cash that we're talking about? So I'm not comfortable with that and I want you to hold equities. What if the market starts going up from here and you're landed up with a lot of cash in your books? That's not my intent. If I wanted you to be in cash, I would have gone into debt funds. So that is one set of investors who think like that. The other set is, of course, I'm investing in an equity fund does not mean that you have to completely be in equity. It's your job as a fund manager that we've been talking, that it's your job to find value. Now, I have invested in an equity fund, but currently if the valuations look stretched, then my fund manager is expected to wait. Come out of equity, hold cash, wait for the right time and enter back again when you feel the valuations are good. So there are both sides of the story. Both have their merits and demerits. The whole idea is that if you're entrusting the money to your fund manager and they believe at this point in time their valuations are stretched and they go on to holding cash. So I think temporarily it's fine, but you need to then monitor this to ascertain whether they're holding cash continuously for a very long period of time, or they're or else they would simply stop taking new fresh fresh applications.
Buying a fresh,
yeah. So all that there has to be some consistency in that. You can't just simply say that I'm holding cash for like 3 years at a stretch. You can't hold 10 to 15% of investments in equity funds in cash. So there is a very thin line. You don't take judgmental calls based on only what has happened over one quarter. You'll have to also interact with the fund house. The fund managers have an investor meet where they actually tell you what they're thinking. So I think you would want to also sometimes follow that.
Yeah, no, just blindly give your money away. It's a good idea to sometimes track as well fact sheets that are released by mutual funds holders every month. Also, Harsh, let's also talk about then SIPs, how they help you ride the volatility. In an SIP, whether the market is down or whether the market is up, you're going to be buying at every price point, right? So I think with the market being down, doesn't the SIP as well sort of help cover up, in the sense it helps equalize or stabilize the average cost that you're buying your units at?
So in fact, let's understand equity investing is, going to be volatile in nature. You do not expect equities to grow by an X percentage every year. That is the job of a fixed deposit. A fixed deposit will grow at a percentage every year. The question is that you do not know how the market is going to behave even tomorrow. So the question is, if I am a long-term investor, I don't know how the market is going to perform in the next 5-10 years. I'm positive that the economy grows, my money will also grow. The question is, what is going to be the journey it is going to take? Is it going to be just a standard straight forward movement? No. It is going to have its ups and downs. Now, how do I ride that volatility? I should not get scared of it. Usually people get scared of volatility.
Yeah.
The idea is if you are conscious about it. So let me take an example of a roller coaster ride. Usually if you're driving in a car, you're going in a car and suddenly your car, just dips a little bit on a road, you're going to feel scared. Okay, you're in an aircraft and suddenly it goes down a certain couple of feet, you're going to feel scared, right? The same thing, you pay money and go in a roller coaster and you actually enjoy that ride.
Yeah.
Right, you actually enjoy that thing coming down,
ups and
downs. So the question is, you're aware, you're buying a ticket, you're getting into this and you believe that it is going to go do that. So you're aware. The same thing if you're investing in equities and you are aware that this is the journey of equities, like a roller coaster. Now it's up to me to accept it and to then invest in it accordingly. So that's why I choose an SIP.
Okay.
What is an SIP? At every level that the market touches in the next couple of years, I'm going to buy every month, every quarter, every 6 months, whatever.
Yeah.
This helps me average out my investments and take care of and negate the volatility, the negative effects of volatility.
Yeah. Okay.
So if something comes down, will you get to buy it at cheaper rate?
Buy it at a cheaper. Of course. So this is basically the markets being on sale. I mean, if you have an SIP, don't stop it because the market has gone down. By the way, let me remind our viewers, our phone lines are open. You can email us as well. I will take your questions and queries, get them answered by Harsh. 24990388 is the number, or you can email us on the moneyshow@etnow.tv. By the way, we just had that mid-cap fund chart. I would just request my producer to pull that up. And while Harsh, what you are saying are golden words of wisdom, but the fact is, look at it, 7,000 crores in a mid-cap fund in April, and then we had 5 and then 3. So I hope all our investors out there are paying attention. Mid-cap flows essentially are how much money is actually going into, your mid-caps, your mid-cap stocks, etc. Mid-cap funds, pardon me. So this is not a very pretty trend, I must say. It's going lower, so I hope all our investors out there are taking heed. But like I said, it's time for our Ask the Money Show segment, and let's get to questions and queries. A reminder for our viewers, the email address is appearing on the top of your screens, or if you call us now, you can get your question answered right away by Harsh. For now, let's take some questions that we have accumulated. We have Arjun Bhan who has sent in a question. He says, I currently own the HDFC Small and Mid Cap Fund. I started an SIP of approximately 5,000 rupees when I started working. That's approximately 3 years ago. Well, no surprises. Now, of course, he's worried the fact that the fund is now turning negative for him, especially because, like I said, mid caps and small caps have really lost a lot of money. His question is, should I stay invested? Harsh, again, something that we were talking about earlier, he's been investing. He may have enjoyed himself in the first 1 odd year of his investment journey, but now, of course, it's cooled off a bit.
Yeah, so Mubina, if you're just pulling up some details of the HDFC small and mid cap that he's referred to. So this, as the word says, as a scheme objective is that invest a major part of its investments in small caps. So about 55% is in small caps, about a 40% is in mid caps, and the rest, about a residual amount is in large caps. Now, most certainly, as we are understanding correctly, that he's worried about the performance. They don't really see returns even after 3 years. So if you look at the performance of the scheme vis-a-vis what the mid cap, index has done, the index is down by about 15% in a year. The last 1 year, negative returns have been 15%. So, very clearly, it's going to fall in, it's going to perform in line with what the markets are doing. If the markets are going down, it's not going to go up. So, all said and done, what he needs to actually decide is whether he wants to be invested in a mid cap fund or no, or a small cap fund for that matter. So, if you understood what a small cap is, and you're investing in a small cap with that thought in mind, then this is one of the best funds in its category.
Okay.
However, if you're worried about being invested in small cap, then of course you need to move out of it.
Move out of it, yeah.
I mean, then you need to go to a large cap or a multi cap for that matter.
Yeah.
So my suggestion to you, Arjun, is that stay invested in this scheme if you want to be into small caps. In case you're not happy with the performance of small cap by itself, then you need to move out and invest into some other schemes which are less volatile compared to small caps, which could be your large cap schemes or could be multi caps for that matter.
Also, Harsh, see, he hasn't mentioned if he has any other funds in his portfolio, but let's assume he's saying that when he started working, he started investing in this fund, and it's an SIP, so great practice. He started saving right from day one. But I don't know, it may be safe to assume that this is the only fund in his portfolio. Is that as well a good choice to make?
No, in fact, if this is the first and the only fund that he's invested into, then this is a wrong choice to do.
Okay.
I mean, you do not start your investment journey in equities through a small cap.
Yeah.
Because in terms of volatility, I mean, small caps are going to be the most volatile compared to large and then mid cap.
Right.
So when you start your journey, I mean, ask yourself, if you were to buy into equities, which kind of companies would you want to co-own? So when you're buying shares, you are effectively becoming a co-partner in that company, co-owner of that company. So which kind of companies would you want to be partners with? I mean, you will want to be amongst the largest companies of the country, right? Because they give you that kind of solace and comfort that they are the biggest companies of the country. If there was any volatility associated or downturn in the economy, the large companies will be able to weather that storm better than what a small cap would be able to. So if this is the first investment that he has made, then the selection of the category is wrong. He selected the right scheme in the category.
But the category itself.
But the category itself is wrong. He should have started with an index fund or probably a large
cap fund. Yeah. So usually when you're new investors, you've just started a job, you want to park your money in equities, you should perhaps choose a large cap or an index fund. Okay, let's quickly move on and take on board our next question. We have Vitthal More who has sent in a query. He says, I have an SIP in the following funds. He's named a couple of them. 5,000 rupee SIP in the Franklin India Prima Fund, and then he also has an investment SIPs in Axis Large Cap and Kotak Standard Multi Cap. So basically 3. Now, simple question, he wants to know if these mutual funds are good to hold in his portfolio. He wants to invest in the long term.
Yeah, so Mubina, you need to make a note of how he's divided his fund. So he has one large cap, which is the Axis Large Cap. He has a mid cap, which is the Franklin India Prima, and a Kotak Standard Multi Cap, which is a multi cap fund. Now, you know how you evenly divided your money into all 3 different categories. You don't have 2 large caps, 2 multi caps, or 2 mid caps. So he's got one in each category, and one of the best funds out of each category.
Okay.
So I think he's done extremely well, and Vitthal, I don't think you need to make any kind of changes. Just continue as it is, and of course, keep increasing investments as and when your income goes up.
Okay, so 10 on 10 from Harsh basically on your portfolio allocation. 1 large cap, 1 mid cap, 1 multi cap. That's a good combination to have. And of course, Vitthal has taken note of the best funds as well. For all our viewers out there, by the way, I'll read it out to you. It's the Franklin India Prima, the Axis Large Cap, and Kotak Standard Multi Cap. All 3 Harsh does like. Again, a reminder, last reminder for our viewers, actually, phone lines are still open. You can call in and we will answer your questions and queries on mutual funds that you own or would like to own. Okay, next up, we have Sarang Pratap who has sent in a question. He asks, is a liquid fund or debt fund better for putting money for a short period of time, and what is the return difference between them? Of course, there's been those new rules as well that SEBI has come out with for liquid funds. So many are wondering whether liquid funds will continue being as effective as they were, because many a times people use savings accounts and liquid funds alternatively.
Correct.
So yes, let's talk about liquid versus debt. In the current scenario, how does it look?
Yeah, so so let's understand within the debt category. I mean, there are some kind of investments which are meant for short term. So I really don't know what to do with my money, but I want to park it away for some time, which could be even a week, could be 10 days, could be probably a couple of months, less than a year. Now, what is my objective when I'm investing money into for this particular need of mine, which is that I want liquidity. Okay, I want safety because I need it within next 1 year. And at the same time, I also want to ensure that it is not lying idle but generating some returns. Now, it may not be double figure returns, may not beat inflation and all those kind of things. Now, when you put all this into perspective, a liquid fund is the most suited in this category. Because if you want money after 10 days, you can simply withdraw out of it and you'll earn the returns that you have proportionately for 10 days. The question is, when you look at debt funds, now his question very simple. What is a liquid fund compared to other kind of debt funds? So within the other debt funds, you have something which is for short term, which is for medium term, which is long term, which is different categories. You have a credit risk funds, then you have gilt funds. There are different category of funds with different durations. So they are to cater to different needs of individuals. So there's a debt allocation that each individual does. Within that debt allocation, if you want to keep for long term, you would choose a long term debt fund, or you want a short term or medium term, depending on that. But if your requirement is very clear, you want liquidity, you want money only to be parked for a temporary purpose, then liquid funds are the most suited for you, and I think you should go ahead with that.
Okay, well, that essentially is the difference between liquid funds and debt funds, and very often we do advocate that. Okay, we do advocate that sometimes liquid funds do tend to give better returns than savings. So you should, if you have that spare cash, you could park it over there. Okay, we have Mr. K. Prabhakaran, pardon me, who is joining us on the phone line right now from Chennai. Mr. Prabhakaran, thank you for joining us on the Money Show. What's your query for Harsh?
Madam, say I want to invest for next 10 years for my retirement and my child marriage.
Okay.
See, I want a portfolio of funds which belongs to large cap or multi cap or mid and small cap like that, which with the allocation of the portfolio I want, madam. So I'm going to invest monthly 1 lakh for next 10 years, madam.
You're going to invest monthly 1 lakh for 10 years. Okay, Harsh, I don't know if you heard his question.
Yes, I did.
Okay, great. So he's a long-term investor. He wants to invest for his retirement. He has a nice 10, 11 years, before he retires, and he can put in 1 lakh rupees per month. And of course, like you as well were mentioning, you should have a nice basket, different categories. So
Correct.
how would you help him start off?
Yeah, so Mr. Prabhakar, what you could do is first consider how much of your money or how much of this 1 lakh a month will go into large caps, mid caps, small caps, multi caps. You first need to draw that outline. So if I were to give you a suggestion, I would say about 50 to 60% of your money that you invest should go into large caps. Now this forms the base of your investing, which means that this is the core portfolio wherein you are holding the best companies of this country. So a large cap allocation would be about 50%. A 30% investment you can make into mid caps, because what we believe is what is a large cap today was a mid cap at one point in time, and it grew to become a large cap. So in that sense, there is a potential for some good mid caps to tomorrow turn into large caps. So your returns will be slightly better than what we expect a large cap to give you. At the same time, there would be some more incremental risk also. So you have to be careful in that sense. So that is why we are allocating 30% towards that. The rest 20%. You could either invest in any sector funds if you are comfortable. If you're not, then do not invest in it. You could choose a multi-cap fund, you could choose international funds. There are lots of other areas that you can consider parking this another 20%. So I'll draw a model portfolio for you. I would suggest amongst the 50% that we're talking about in large caps, pick two schemes. So you will invest 25,000 in each scheme. So one is an Axis Blue Chip fund and the other is an ICICI Blue Chip fund. The 30% that we're talking about will go into mid caps or a multi cap, as I suggested. So a mid cap, you can pick up an HDFC mid cap opportunities fund, or a multi cap, we've already spoken about the Kotak standard multi cap. Now the 20% that I've recommended that you can put in either sector funds or international funds, that is, I leave it up to you. In case you do not want to go into that, the 50%, which is 30% of mid caps and this 20%, you divide it equally between the multi cap and the mid cap schemes.
Okay, I hope, Mr. Prabhakar, you've taken note of all of those schemes that Harsh has mentioned. Okay, very quickly, we have Mr. J. Thakur who is joining us on the phone line. Good evening, Mr. Thakur. What's your query for Harsh?
Good evening to both of you. I had a small query. I'm already invested in the Franklin India Dynamic Accrual Fund.
Okay.
So I wanted to understand, once we are looking at this current ecosystem, the Indian economy and things of that sort, where would you stand in the debate that right now it is better to have an accrual-based mutual fund or a duration-based mutual fund? I would like Mr. Harshvardhan to throw some light on that. And secondly, when we are looking into a debt fund like this, is it absolutely essential for us, retail investors like us, to actually study under a microscope the underlying assets which are there?
Yeah.
Should we study that under the SID or whatever?
Yeah, it's actually a very good question, especially because we have seen a lot of funds NAVs being hit because of DHFL and RNFS, etc.
Yes.
So Harsh, if you could take his questions.
Okay, so Mr. Thakur, I'd like to make you understand this, that when you're talking about investing in debt, let's take it from the top, because sometimes we tend to miss the broader objective when we get into the scheme specifics. So when you're investing into debt as an allocation, so you could, we always suggest have a prudent asset allocation plan in place. So you have some amount of money going into equity, some amount is going to debt. Your equity investments are supposed to create wealth for you, beat inflation, take that additional risk. When you invest in debt, what is your objective? Your objective is for stability, your objective is to earn decent returns, and your objective is liquidity, that any point in time, if you have emergencies, you have any kind of requirements, you can fulfill those requirements out of debt investments. So debt investments essentially aren't supposed to be taken into a portfolio with returns or high returns in mind. So keep in mind, very simple, what do you expect out of a debt fund? I would say anything better than a fixed deposit in a tax efficient manner is a debt investment. Now in that sense, if you are in an accrual fund, that gives you peace of mind. If you're investing into duration-based funds, then you're trying to time the interest rate movements and RBI policies, the reduction in interest rates, or all those kind of things. Do you really want to do it? I mean, if I were an investor not related to financial field, I would not want to do that. I would simply invest into a debt fund, expect that I get more than fixed deposits in a tax efficient manner. If I get an 8%, I'm more than happy. If I want exponential growth and returns, I would look at my equity portfolios. I would not fiddle with my debt investments and take exponential risk in that. Now, in that context, given the current ecosystem that your question actually is targeted towards saying, looking at the interest rate scenario, expectations of interest rates going down, RBI is under pressure to boost growth, and that is why there is expectation of reduction in the repo, etc. I would say that you stay out of all this. Keep yourself away from all this. Cut down all the noise. Stick to the accrual fund that you're in right now. And if you're happy with the kind of returns that you're getting, which is about 8 to 9%, I think you're doing good. So let's just keep it simple with that. And your second question, whether you should go into the papers that each scheme is holding and under the microscope evaluate whether if there is any investment that you should be worried about. Quite frankly, you should take some interest in your investments, but can you microscopically go inside and actually evaluate? Because if we talk about certain SL group companies, I mean, until recently we didn't know that these companies belong to the SL group.
I mean, who knew that Z Entertainment and names like that would have a problem?
Yeah, and the issue is the companies that have actually delayed their the payment of bonds, we would not even at that point in time know they belong to the SL group.
Right.
Because they were under different names. So question, even if you go under the microscope and try and look at papers and their cash flows, I don't think you will achieve anything great. So stick to good funds. That the purpose of diversification is served when each mutual fund is also investing only a portion of their assets into a particular company. So I think at that juncture, leave it and just go about it. Unless you really are educated enough to go into microscopically looking into those schemes, which I believe lay investors would not be.
Well, we at ET Now as well will try to, of course, always keep you up to speed on that. So stay tuned. In fact, just on Friday or Thursday we had done an entire section on what yields are doing and how yields are moving and impacting debt mutual funds. So I don't know, Mr. Thakur, if you're able to catch that. But yeah, that's of course makes sense. I mean, you're paying a fee to the fund manager. Might as well, let him do his job and have faith in him. All right, Harsh, with that, we're absolutely out of time. So thanks so much for joining us on The Money Show and answering all the questions and queries.